Hi, my name is Sid from KOSEC, Kodari Securities, and today I will be going through the Stochastic Indicator or Stochastic Oscillator. This is a technical indicator we implement here at KOSEC and what a lot of professional investors use as a guide to better time entry and exit points and pinpoint reversals. As always, any information given is general in nature and doesn't take into account your personal needs or objectives. For further information, please visit our website www.kosec.com.au. Now here is an overview of what will be covered in today's presentation. First, we'll start off with the basics. What is the stochastic indicator and what does it consist of? Or really, what will you see when you bring it up on a charting tool? Then we will move on to a bit of a theory behind it, the formula behind it, how does it work, how it's calculated, and so on. Move on to how to read it and how to use the indicator. And then we'll move on to an example. So I'll show you how to use it on a very well-known stock, a big company. And then the last thing is the common mistakes that a lot of people make when trying to use the stochastic indicator. Now, what is the stochastic indicator? The stochastic indicator or stochastics were developed by George Lane in the late 1950s. Also referred to as the stochastic oscillator, it is a momentum indicator that compares the most recent closing price relative to its previous high-low range. In layman's terms, as put by George Lane, if you visualize a rocket going up in the air before it can turn down, it must slow down. So therefore, what he's trying to imply is that momentum always changes direction before price. So what does the stochastic oscillator or stochastic indicator actually consist of? Now, the most important thing is this blue line right here, which is the percent K line. This percent K line represents the value of the stochastic, which I will explain on how to calculate in the next slide. This red line right here is the percent D line, which represents a moving average of the percent K line. So really a smoothed out version of the percent K. And the time frame in this picture is actually set to 14 over here, as you can see. Now, this setting is usually a very commonly used or default setting for the stochastic oscillator. And this 14 can represent days, weeks, months, or an intraday time frame. And lastly, the range is usually defaulted to 80 on the upper limit and 20% on the lower limit. Now shown here is the formula for actually calculating the value of the stochastic. As you can see here by the formula, you start with the most recent closing price, subtracted by the lowest price traded for an X amount of prior trading days. Now this X will usually default to 14, as I mentioned in the previous slide, which is one of the most commonly used settings. And then you go into the denominator, which is the highest price traded for the same amount of X or 14 trading day period, subtracted by the lowest price traded for that same period, and times that fraction by 100. And then, as I mentioned previously, also you've got the percent D line, which is defaulted to a 3-period moving average of the percent K line. Now, reading the stochastic indicator is fairly simple. Just boiling it down to the basics, we've got it very similar. If you look at it, it's very similar to an RSI in the fact that you've got your upper limit set at 80%, as I mentioned earlier, and your lower limit set at 20%. With the RSI, and I know it's usually 70-30, but it's a similar concept. And then yet again, you've got your overbought territories up here when it's above that 80%, so overbought. And then the same thing for under that 20% limit, you've got your oversold territories. Now that we know where our overbought and oversold territories are, what you want to look for is a transaction signal. Now, with the stochastic oscillator or stochastic indicator, a transaction signal could be identified when the percent D and the percent K cross, just like it does there. Now, this is in the overbought territory, and once again, the percent K is crossing south of the percent D. So that would be a potential guide of a transaction signal to sell. Now, the reverse is applicable as well. Say, for example, right here, we've got another reversal or a cross of the percent K and the percent D. However, the percent K is crossing north of the percent D, and it's also very close to oversold territory, or almost on the line of oversold territory. So that would indicate a potential guide of a transaction signal to buy or long. Now let's look at an example of how to use the stochastic, or how to read the stochastic indicator on a stock. Now, if you look at the chart here, it's a chart of BHP Group. ASX code is BHP, and this is a very well-known large market cap company. Now, if you look at this point right here, this is a high that it reached, and you'll notice that before it drops all the way back down here, there is a cross right there on the stochastic in overbought territory, and then it goes back from overbought all the way down to here, which is relatively around here before it comes back up. And you'll also notice the same thing, that the percent K line crosses the percent D line north before the reversal. So this gives you a bit of an idea of how to use the stochastic indicator or oscillator as a guide to help you spot these reversals in share price. As George Lane put it quite eloquently, momentum always changes direction before price. So, when using this in combination with things like MACD, you will always see the stochastic indicator cross before the MACD actually does. As I mentioned in the previous slide, what you're looking for in the stochastic oscillator is the crosses of the percent K and percent D, and looking at whether it's an overbought or oversold territory to really optimize the swings in the share price. Now, there are a couple mistakes that a lot of traders make. One is just using the stochastic oscillator by itself. I would like to reinforce that you should use a couple other technical indicators to really optimize that entry and exit point, and also just blindly going against a strong market trend due to the stochastic oscillator. Once again, the stochastic oscillator is an indicator of momentum, and if you go against a strong trend, then you are going against strong momentum. And within the next two slides, I'll go through a couple examples on how these mistakes can really cost you. This is an example of a stock that has been on a very strong bullish trend. It's a 1-year chart of Commonwealth Serum Laboratories Limited, ASX code CSL. Now, as you can see here, it has been continuously trading above that 200-day moving average, and it's just kept running and running. So if you just use the stochastic oscillator by itself and just took short positions or sold in these areas, where it's in overbought territory, then you would have really missed out on this run, because this stock has just continued to run and run. The same goes for a strong downward trend or bearish trend. If you look at the stock here, it's the stock Whitehaven Coal Limited, ASX code WHC. As you can see, around a 1-year time frame, it has been on a strong bearish trend and it has continued to drop. Now, if you had taken a long position just blindly because it was here or anywhere here, you would have been caught in this whole downward trend. If you didn't have a stop loss, it would have just continued to go down and down. If you had a stop loss, you'd have probably got stopped out, which is a smart thing to put in there. However, once again, just blindly longing or buying in these oversold areas will cost you dearly. So in this presentation, we took a look at the stochastic indicator and how it works. We went through how to use it, looked at an example, and also looked at what to avoid doing. Hope you have found this video helpful. This video has been brought to you by KOSEC, Kodari Securities. Thank you and have a nice day.